Hello everybody and welcome back to video number 3 in chapter 14. When we left off, we were looking at preferred stock, in this case, callable preferred stock. We discussed cumulative preferred stock, but also we have participating preferred stock, convertible, callable, and redeemable preferred stock. And a callable stock means that the company can call that back at their discretion, whereas redeemable means that they may call that back, or that stockholder, preferred stockholder can redeem that at their discretion. Okay, a corporation may attach whatever preferences or restrictions to its preferred stock as long as it does not violate the state incorporation law. Remembering again, these are state incorporation laws. Okay, so here is a redeemable preferred stock for mezzanine reporting. Alabama Power here. So here's our redeemable preferred stock. This is how we would present it. Cumulative redeemable preferred stock. Cumulative, of course, means, as you had in 1A or 101, means that if for whatever reason the corporation doesn't pay a dividend in a prior year and it wants to pay dividends in a current year, it has to make the preferred stock holders whole in the previous year and the current year before it can pay any dividends to common stockholders. Okay, so this one is authorized, it has outstanding shares, and then here's our par value at a 5%. So it has two classes of preferred stock here. Okay, the types of preferred stock. Callable, as I mentioned, that permits the corporation at its discretion or option to call or redeem the outstanding preferred shares. Redeemable, as I mentioned, allows the stockholder to redeem it at any time. Okay, convertible preferred stock. Here, the Marinelli Corporation has outstanding par value of convertible preferred stock of $400,000 and related paid-in capital in excess of par preferred stock of an additional $60,000. So stockholders convert that preferred stock into no par common stock, which is presently reported at $1 million. The fair value of the convertible preferred stock is $600,000. How would Marinelli record that conversion of this preferred stock? They would make the preferred stock $400,000, given in the problem here, zero out, as well as the paid-in capital, given in the problem here, zero that out, and convert that to common stock at $460,000. The preferred stock and related paid-in capital in excess of par accounts are debited at their book value. The common stock does not have a par value, so the entire amount is credited to common stock. Marinelli does not record any gain or loss when dealing with stockholders in their capacity as business owners. And as you see, the fair value was more than $460,000. So an important point there. All right, here we'll take a look at issuing some stock. The Stengel Company was organized March 1, 2025. It is authorized to issue 20,000 shares of 5% $100 par value preferred stock and 1.5 million shares of no par common stock with a stated value of $1 per share. The following stock transactions were completed during the first year. Okay, so March 1, they issued 80,000 shares of common stock. Let's move ahead a little bit and we'll come back and forth to this slide. Here, on March 1, we're going to debit cash for $400,000. That's 80,000 times $5. Common stock is going to be 80,000 times the dollar stated value. And then the differential of 320,000 we credit to paid-in capital in excess of stated value on common stock. Now, on March 10th, here, we issued 5,000 shares of preferred stock for cash at $112 per share. That's a pretty easy one. We just take 112 times 5,000. That's how much cash we got. The preferred stock at par was 5,000 times $100, or 500,000, and that differential representing $12 per share would be 60,000 paid in capital in excess of par preferred stock. Now, on April 1, we issued 24,000 shares of common stock for land. The asking price of the land was 90,000. But the fair value was 70,000. We don't care about the asking price. We care about the fair value. So what we're going to do here is we're going to debit land for $70,000 fair value. Common stock will take 24,000 shares times $1 gives me 24,000. And then the paid in capital in excess of stated value here is going to be $46,000, the difference between 70,000 and 24,000. Okay, then on August 1, we issued 10,000 shares of common stock to attorneys in payment of their bill of $35,000 for services rendered in helping the company organize. Okay, so here we're doing essentially the same thing. Our organization expense is going to be $35,000, but we're paying for it in stock. So we take the 10,000 shares times the dollar par value here, and paid in capital in excess of stated value common stock would be the 25,000 differential. And lastly, on November 1, we issued 10,000 shares of common stock and 1,000 shares of preferred stock for a lump sum of $280,000. The fair value of the common stock is $120,000. So fair value of the preferred stock cannot be determined. So we need to allocate here. And what we do is just that. We got $280,000 in cash, 10,000 at $1. That's $10,000. Paid in capital in excess is 110,000. The difference between 120,000 and 10,000. And then preferred stock, we do the same thing. We had 1,000 shares at 100, or $100,000. So the preferred stock, then, we're going to take the total of 280,000, back out the 10,000, back out the 110,000, back out the 100,000, and that leaves me with 60,000 paid in capital in excess of par on preferred stock. Okay, now we'll move into a different topic called reporting for reacquisition of shares. All right. So buybacks can occur for a variety of reasons. And so here's a little graph showing how cash is deployed for different kinds of expenditures. Now, if the stock is undervalued, that might be a reason for buybacks. The only example that I've had in my career has been just that. At Chrysler, we knew we were undervalued back in hindsight, and we bought back our own shares, and it really lifted the stock price immediately. Here, Warren Buffett's Berkshire Hathaway's is saying the same thing. He's saying that to time buybacks to pay less than the stock's intrinsic value, its true worth, and by so doing, the remaining stockholders will receive additional returns in the marketplace because there's less shares outstanding. That's exactly what Chrysler did. Now, sometimes for dividend commitments, we want more flexibility in making dividends. And so General Electric commits to a given dividend every year, and it's often reluctant to cut that dividend because it's well known that that would signal to the market that the company might be in trouble. So a buyback provides more flexibility to the company as to whether a distribution in a given year should be made. Dilution issues here. Buybacks help prevent dilution of ownership of existing stockholders. So Honeywell reported that it would use a part of its purchase of 1 million shares for employee stock compensation plans rather than issuing new stock to executives and employees. Okay. Maintaining control. A company may want to reduce its shares if it's concerned about a hostile takeover. If it has more control over the shares, it makes it more difficult for a possible unfriendly acquirer. I've seen that happen several times in my career. And lastly, a change in performance metrics. They might buy back shares to increase various financial metrics, the big one being earnings per share and return on equity. And by example, that buying back shares, the company increases earnings per share because the denominator is reduced. If the company has earnings of $1,000 and has 1,000 shares outstanding, its earnings per share, of course, is $1. If it buys back 200 shares, its earnings become $1.25. And that metric makes the company look better, although the earnings of the company has not changed. Other metrics, such as return on equity or return on assets, are also positively affected by buybacks. Okay. One thing they haven't mentioned here is also sometimes buying back your shares can affect the stock price and drive it up. Okay, treasury stock is not an asset. It is a contra stockholders' equity account. So please keep this in mind. A corporation may later sell that treasury stock to obtain funds, but that does not make treasury stock a balance sheet asset by any means. Number two, when a corporation buys back some of its stock, it has not acquired an asset. It reduces net assets before cash is used. And lastly, number three, possession of treasury stock does not give the corporation the right to vote. We don't pay any dividends on treasury stock. Treasury stock does not give any voting rights. Okay. And it doesn't receive assets upon corporate liquidation as well. And lastly, reacquisition of shares. Two acceptable methods. The cost method, most widely used, and the par value method. Treasury stock reduces stockholders' equity. This looks like a good place to stop this video, and when we return, we will take a look at how we purchase treasury stock. Until that time, bye for now.